Interest rates are probably the most talked about and misunderstood part of the home buying process. You hear things like rates are up, rates are down, marry the house, date the rate, and everything in between. But here's the problem. Most buyers don't actually understand how interest rates impact their affordability and the purchase price of a house. And I'm seeing this cause a ton of hesitation and way too much confusion. And in some cases, people are making the entirely wrong move. So in this video, we're gonna simplify the entire thing. No headlines, no hyperbole, no dramatic statements, just me and the founder of Atomic Mortgage, Jonathan Esposito, to break down the lending side of things. What do interest rates actually do and what impact do they actually have on your home buying process? If you haven't met me yet, my name's David Constant and I'm a local realtor right here in Hartford County. And I help people just like you make the move to Central CT every single day. So whether you're moving in 9 days or 90 days, be sure to give me a call, shoot me a text, or send me an email, and I can't wait to help you make Central Connecticut home. And before I forget, be sure to click the link below to download my free relocation guide. It gives you everything you need to know about the schools, the hospitals, the employers, what neighborhoods, and where and what towns. So without further ado, Jonathan, I want to kick it over to you. Just introduce yourself and tell us a little about who you are.
Thank you so much for having me. My name is Jonathan Esposito, founder and CEO of Atomic Mortgage. Just fortunately, because of great partners like you, I'm one of the top brokerages, not only in the state of Connecticut, but in the country. So thanks again for having me.
Yeah, of course. So on today's video, we're talking about interest rates.
Big topic.
Everybody loves talking about interest rates. And I mentioned this on a prior video, but I bought my house in 2015, and honestly, I can't tell you what the interest rate was when I bought the house. I don't even remember thinking about what the interest rate was. I just was thinking about the monthly payment. Since then though, I really want to say maybe 2021 with like the great refinance. Yeah. It seems like everybody and their brother wants to talk about interest rates, right?
Unfortunately, because of recency bias, people are so attached to, oh, well, I had a 2%, my family has a 2%, I know this person with the 2%. Or once again, it took a once in a century global economic shutdown, a pandemic to get there, right? And so if you look at it, national averages are well above where we're currently at, right? We're right around 6, high 5s, low 6s. We're bouncing around right now. There's a lot of volatility, which I'm sure we'll get into right now, just because of global factors. But that's a really strong spot to be, right? And that high 5s, low 6s, that's better than national averages, historically speaking, right? And so that's why I think hopefully the recency bias of those two are starting to fade off as each day goes by. But yeah, I think people are still talking about it a lot.
Yeah, so let's actually talk about that, right? Let's zoom out a little bit. And I want to hear from you. Where does the interest rate actually come from? What impacts whether or not the interest rate goes up, whether or not it goes down, whether or not the Fed cuts? We hear all this stuff in the news every single day. So simple, what actually causes the mortgage interest rate to go up and go down?
Yeah, so there's a lot that goes into it, right? There's economic conditions, there's policy, there's financial markets. Right now, since COVID, the biggest driver in rates is stemmed around inflation. And that's what is driving markets right now, right? And I think, once again, I'm going to dive into the weeds a little bit, hopefully not too deep to lose people. But if you go back to COVID, interest rates were at an all-time low. The Fed's fund rate was 0%. So banks were just charging their 2 to 3% premium on top of it. But that was truly, as people said, free money, right? The Fed fund rate was 0. So that was to help stimulate the economy, right? There was a global pandemic, economic shutdown. The government was like, how do we have people start spending money, right? And that's why 0% credit cards and super low interest rates, that encouraged people to get out and spend money, even though unemployment was high, job conditions weren't great. But when there's free money circulating, that's what kept the economy going. As COVID started to come to an end and we started to get on the other side of it, we had so much money out there that inflation came, right? It caused inflation. So that's why, in order to slow down spending, the Fed had to increase their rate in order to get to a point where people are like, okay, well, it's no longer free money. Let me pull back. That took a very, 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 very long time to happen. And that's why people would always say, hey, the Fed is increasing their rate tomorrow or next week, whatever it may be. Rates are going to jump. Not true. They don't follow the Fed decision as closely as people think, right? The Fed could increase their rate, which if you think about it, an increased rate could lead to the economy slowing down, right? If money becomes more expensive to borrow, you would think less people are going to go and borrow it. It'll slow down the economy. Slowing down the economy is good for mortgage rates. Mortgage rates are bonds. So bonds perform well in slower economies, right? When people are looking to be more safe with their money. Once again, go back to the beginning of COVID, everyone is panicking, global shutdown on, global pandemic and economic shutdown. Therefore, money is flooding into the bond market. Mortgage rates are really, really low. So that's why it's funny, when people say, oh, well, once again, the Fed is dropping their rate tomorrow. That means rates are going to drop, or the Fed is increasing their rate tomorrow. That means the rates are going to increase. Not necessarily. And it has to do right now, it has to do with inflation and where people think that's going to land, and traders and investors where they think that's going to land.
Yeah. So what I hear you saying is that it's not as simple as following the Fed, right? We hear this Fed rate cut and we assume that mortgage interest rates are going to follow. It's actually a much bigger pie than that, right? We've got probably the biggest piece of that pie is inflation. We have economic conditions. We have, employment, right? We have these employment factors. We have economic policy, right? And least of which isn't what's happening globally, right? Over the last couple of years, we've had the Ukraine war, we've had the Iranian war now, right? We have these things that are influencing energy supply. We have these things that are influencing just the cost of doing business generally, and that's going to impact interest rates.
I mean, take what's going on with, in Iran right now, which is obviously a massive oil hub. And so, great. There's tension there. They're threatening to pull back oil supplies and to shut down the canal, which will disrupt the oil flow and energy. And therefore, the war is inflationary. Then you throw oil on top of it, which is extremely inflationary. Then, therefore, the 10-year treasury yield has spiked up and mortgage rates have gone up, right? And that's why, to go back to your point before, the Fed controls the Fed funds rate. That is the overnight short-term lending. What people ask me all the time, if I'm trying to track where rates are, what should I look at? It's not a perfect correlation, but it's pretty good. The 10-year treasury. Longer term debt is what mortgage rates are tied to, right? The Fed funds rate, although they are trying to help with the future and trying to be forward thinking and control the market one way or another, that's short-term lending, and it's not directly correlated with mortgage rates.
So now that we have, an understanding of what impacts interest rates and our mortgage rates, let's actually talk about specific examples, right? So could you talk to me a little bit about, the difference between, let's say, a 6% and a 7% mortgage? How does that actually play out for a prospective buyer? Because for me, it's 1%, right? Well, 1%, that couldn't possibly have that big of an impact, but people are freaking out about, 0.5%, 1/4% at sometimes. So you see it every single day.
Yeah. So they say 1% equates to about 10 to 12% increase or decrease in affordability, right? So if you're looking at a $300,000 home at 7%, and that's your max, and that's what you could afford, rates now go down to 6%. You should be up about 10 to 12%. So that goes from a $300,000 house to a $335,000 house. So high level, it does impact affordability. Obviously monthly payment could fluctuate on as well. You take that 1% on a 300,000, and I'm just ballparking here, so maybe $200 to $300 a month. On the $300,000 loan, something in that range. So yeah, that's pretty much what it translates over to.
Sorry to interrupt, Jonathan, but we're talking interest only on that too, right? Because so we're thinking about your long-term investment. If the rate drops by 1% or 0.5%, and that's going to save me, let's call it $100 a month. That $100 is going right back into my pocket because that's exclusively interest.
Right. And the beauty, and specifically for Connecticut, the beauty of it is of the refinance, right? And so you go in, you buy a house, ideally rates go down. You would think when rates go down, there's going to be more people that are entering the market, which will drive the price up. But if you already bought your house and now rates go down, you could go in and refinance and drop your monthly payment, right? And that's just direct savings for you. And fortunately, in Connecticut, closing costs are very cheap relative to other states, right? Even bordering state, New York, closing costs, and they have transfer taxes and stuff. Closing costs could be 2, 3, 4 times what it is in Connecticut.
Yeah.
Right. So very cheap.
So I'm seeing the highest levels of inbound migration, right, are coming from Massachusetts, and they come from New York. That's where most people are flowing into the state of Connecticut from other parts of the United States. And when we're stuck in Connecticut, a lot of times, especially if we're around West Hartford, Simsbury, Avon, Glastonbury, we can lose perspective, and we can say, these are, quote unquote, more expensive towns. But when you zoom out and you look at it on a regional basis, right? When you look at what, $700,000 can buy you here versus in the suburbs of Boston, or $700,000 can buy you here versus, Westchester County, right? It's night and day.
I'll never forget during COVID, and once we were on the other side of it, where, people were getting more comfortable and the real estate started skyrocketing. We had a client right here in town, just a couple blocks away, going over $200,000 above ask. And I remember it was like kind of the talk of the town. And I'm like, whoa, what's going on here? And I'll never forget the conversation I had with the borrower. And I asked him, I'm like, wow, obviously it's a beautiful house, but you came with a very strong offer. They're like, we're coming from Westchester. I would have paid 1.2 for this house, or more in Westchester. And that was my budget. I just got relocated. I was a doctor and I just got relocated. So I'm going in at $750. That's a steal, right? And so when you're relative to a lot of our surrounding states where people are coming from, especially everything that you get in these areas, it's crazy to see, right?
Yeah.
And it's still very cheap relative to, some other parts of the country.
Yeah, and it's part of what makes, Hartford and the greater Hartford area one of the most desirable housing markets in the country, right? And you just have to look at lists like Zillow and whatnot.
And you look, and it was stagnant for so long.
Of course, yeah.
So that's why, now obviously with COVID and work from home and, jobs moving, yes, we were already due for a pop, and then you take everything that's going on top of it, and that's why we're seeing a really big jump up. But yeah, it was stagnant for a while, and now we're seeing it quite the explosion.
So I get this all the time from folks that are coming to open houses, people that call me on yard signs. They're kind of kicking the tires a little bit. They know they want to buy a house eventually. They're not sure when they want to buy it. And, they call me and they say, I don't know if I should jump in now or should I wait, right? And they tie that a lot of times to the interest rate. What would you say to, the prospective buyer who is waiting for the interest rate to drop into the 3s or the 4s or, the high 2s again, that like we saw in 2021?
Yeah. So it might take a while to get there, if it ever does get there. And I think it's important to just have the conversation and go into monthly payments and go into your budget and go into what it means to own a home. And I love having that conversation when people say, I don't want to buy until it gets to 3%. Okay, so what are you doing in the meantime? I'm renting. Okay, do you know renting is 100% interest? You're getting zero equity out of that? And they're like, okay, well, I guess that's a good way. That's a good way, way to put it. And then they quickly change their mind, right? And so I think educating yourself and understanding what it means to rent versus buy is really important. Understanding what changes in the market mean. And hey, you know what? Rates are 7%, but now they're 6%, or now they're 5%, and what a refinance looks like and how that could save them a lot of money with, once again, not jumping up their purchase price, right? Because they have that locked in. And so I think looking at it big picture is something that we do really well with the clients to understand and hopefully make them a little bit more comfortable with rates that are in the mid single digits.
Yeah. And then you layer on top of that, some of the recent data coming out is about pre-COVID, the average homeowner stayed in their house about 7.1 years. Recent data is actually showing us that the average homeowner is in their home about 12 years. And that's a much bigger conversation about why the housing market is as stagnant as it is in our area.
Right.
But when you think about that through the lens of interest rates, if the average homeowner is staying in their house for 12 years, even if there's not an opportunity to refinance, right? What we oftentimes say is you can't time the market, it's time in the market. And so as a homeowner myself, I bought a home 10 years ago, and the equity that I've accrued simply by being in the market for 10, 11 years, it's something that I couldn't have gotten otherwise.
Right. I mean, your home value's probably doubled.
Yeah, it
right?
has.
If not close to, right? And so that's why it's unbelievable. Like you said, it's time in the market, which is really important.
Yeah. So something that's oftentimes connected to interest rates are these things called buydowns, right? You have these, if I do a 2-for-1 buydown or buy a couple points here, a couple points there, that stuff's all foreign to me. I'm going to be honest with you. Could you just give us the Cliff's Notes on what are buydowns? Are they something that you explore with your clients? Is it something that folks should avoid?
Yeah, definitely. I mean, there's a bunch of different options, right? And there's very strategic buy downs in terms of like a 3-2-1 buy down, a 2-1 buy down, a 1-0 buy down, or just not a buy down, but an interest rate reduction in paying points. And so those are a bunch of different strategies that we will look at and discuss with the client to see if it makes sense. And that's something that we do on every single loan. When it's time to go in and time to lock, we'll discuss that. Hey, today's no point option is here. In order to buy it down to here, it'll cost this amount of points. This is your monthly savings. And then that's how we make the determination of whether or not it makes sense to do it. So for example, if somebody's at a 6% right now, or that's where the market is, and they're like, I really, really, really want a 5.5. We'll look at the numbers. So 1 point is 1% of the loan amount. So I'm just going to make a complete fake example here. But let's just say, okay, it's $1 million loan amount. And so 1 point, $10,000. Okay, going from a 6% to a 5.5%, let's just say it drops your payment by $1,000 a month. So you take that $10,000 divided by 1,000, that's only 10 months for you to earn your money back. So now you're going through, you're like, wow, okay, well, that's, a really good deal. I'm probably going to be in this house in the next 10 months, and rates are probably not going to drop that much in 10 months, in less than a year. Okay, that makes sense. Because as long as I'm here month 11, I'm breaking even, I'm saving money, right? Where if you go and you run the numbers and you're like, okay, you're saving $100 a month, and it's taken 100 months to break even, that's a much different story, right? Because that's now several years. You zoom out, okay, rates are probably going to drop before then. So let's not spend the money on the buy down or on the points, right?
Yeah.
So that's general rule of thumb. And once again, we do that with every buyer. We put together a nice chart. Here's where you're at. Here's how much it costs to go down to a 5.875, a 5.75, a 5.625, a 5.5, so on and so forth. We'll look at all the break evens and we'll say, yeah, I don't think it's worth it at this point. Or, hey, you should jump on this one. So that's a discussion that we have.
All right. Yeah, that makes a lot of sense. And it sounds like that's probably, not all the time, but probably best for folks that have a little bit more cash on hand on the outset that they can put towards, a buy down or something like that.
Exactly.
Yeah, makes sense.
Yep.
Switching gears a little bit.
Yeah.
We talk a lot about fixed mortgage versus adjustable mortgage.
Yeah.
Right. Can you just talk to me a little bit about the difference? Like, what is an adjustable rate mortgage?
Yeah.
What's a fixed rate mortgage? Do you promote one over the other? Do you want to steer clear one over the other?
So let's start with the most standard loan that we see is a 30-year fixed, right? But on the fixed, we actually have programs that go anywhere from 8 years all the way up to 30, 8, 9, 10, in increments of 1. So, and that's fixed for the entirety of the loan, and it's an amortizing loan. So let's just say on a 30-year fixed, you're going to make your payments. Your interest rate will never go up. Right? The only way that your payment would go up is if your taxes or your insurance went up, but your principal and interest payment do not go up, do not change for the entirety of the loan term. And at the end of the term, since it's an amortizing loan, it'll be zero. The balance will be zero. You're paying it off during that time. Then there's the ARM, or the adjustable rate mortgage. And so if you hear a 5-1 ARM or a 7-1 ARM or a 10-1 ARM, that means that your interest rate is fixed for that 5, 7, or 10-year period, and it adjusts every 1 year after that. Or if it's a 5-6 arm, that means it'll adjust every 6 months after you hit that period, right? And then it's based on market value at that time. So if somebody were to think that rates are going to go down, great. They might go in, take an arm, have a shorter fixed period because they think after that rates are going to go down. So then they'll be in an adjustable rate at that time at a lower market, or they'll refinance into a fixed at that period, right? And so typically the arms have lower interest rates compared to a 30-year fixed, for example, because there's less risk on the lender side, right? Because, okay, you're fixed for only 5 years. Based on all their calculations and the analytics, they think that this rate is a fair rate, right? Well, they'll still be in the money and it'll stay at that for that fixed amount of time, become variable after that. Where on a 30 years, since it's a longer period of time, there's more risk involved to the lender. So that's why the rates are typically a little bit higher. Over these past few years, it's been very, very, very unique where there hasn't been that much of a benefit to an arm versus a fixed, or a 30-year fixed in particular, because there's been an inverted yield curve, right? And once again, not to get like too much into the weaves, but shorter term debt has been more expensive than longer term debt with inflation that we were talking about. And therefore it hasn't been a big advantage, but things are starting to turn with the market, economic conditions. Things are starting to turn and cool down a little bit. And so who knows, we might see arms become more attractive, if the yield curve kind of flattens out a little bit.
Yeah, that makes a lot of sense. So what I hear you saying is that a couple of different things. Number one, an adjustable rate mortgage is one where you have a fixed rate for a certain amount of time, might be 5, 7, or 10 years. And then once that time limit expires, then you'll have a variable rate based on what the market conditions are.
Correct.
Right?
Yep.
And the other thing I hear you saying is that at any time, or at most times at the very least, you could refinance out of that arm.
Anytime.
Okay, so at any time.
And even if it's a fixed, 30-year fixed,
Perfect.
you could refinance. Arm, yes.
So if I jump into an arm, it's a 7-1 arm and it's year 5, and all of a sudden rates drop to something that's maybe a little bit more agreeable. In my own mind, I can now jump into that 30-year fixed rate and lock in that 5% or whatever that rate might be. Perfect. All right, that's really helpful, because I know that a lot of my clients are always thinking about how can I know I'm going to make a little bit more money down the line. I know that projections are my income's going to be higher. So if I can save a little bit of money now, and then lock something in longer term, that's agreeable to them.
Absolutely.
All right. So I'm not going to hold you to this, Jonathan. And I know this is probably the last question you want to get, but I got to ask, because I know people are wondering, where are rates headed? Like if you had to, not necessarily make a prediction, but just from your expertise, right? From your chair, when somebody walks up to you on the street and said, "Oh, you're Jonathan Esposito of Atomic Mortgage," what's going on with rates? Where are they going in the next 6 to 12 months?
I say, let me get my crystal ball.
Yeah, exactly.
No, but in all seriousness, and I know a lot of people have probably heard this for now a few years, right? But I really do think that rates are going to be coming down. There's a lot. Not to get political in any way, shape, or form, but President Trump, he's a big real estate guy. He preaches, he's been saying since day one, he knows that housing is the backbone of our economy, and he wants to make it more affordable. He's been saying that since while he was running, right? So we know that he is very, 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 very keen on doing everything he can to try and promote lower rates. There's a new Fed chair speaker that's coming in. Right. And so Fed Chair Powell is getting replaced. It's effective in May, May 15th, I believe. And so the new Fed chair that's coming in obviously knows that President Trump is very pro, rate reductions. And so I'm sure that there's going to be things that come into play that'll help drive down rates in that regard. And then also, I know this is very, very, very specific to this moment in time, but everything that's going on in Iran, like we hit 3-4 year lows, and then almost immediately everything that's going on in Iran started happening, which is inflationary, as we spoke before, which spiked up rates. And so hopefully once that cools down, we'll be back on that downward trajectory of rates, which everyone wants.
Yeah. I mean, I think everybody wants it. And, it's a delicate needle to thread, right? Definitely. Because on one hand, as we've talked about before, the lower the rate, the lower the payment for the same price house. But on the other hand, when rates drop, we know those pre-approval applications jump, the buyers come back in the market, and competition rises. So I think, one of the takeaways I've had from this conversation, I want to know your perspective is, while rates are important, and it's important to maybe understand where your money's going, because at the end of the day, a $2,500 or $3,000 or $4,000 mortgage payment, you should know where that money's going. What's even more important than what the current interest rate is what's your strategy, and how are you gonna make that dream home a reality?
Correct. Yep. How do you get in? How do you get in the game? How do you start building equity? What's the alternative, right? Once again, renting, you're paying 100% interest. So you want to have a game plan, right? And you want to know that it makes sense for you based on your long-term goals, your career, whatever it may be. But it's important to have the conversation, right? Because once again, you don't want to try and time the market. That might not work out so well.
No, not at all. All right, Jonathan, I really appreciate your time.
Thank you.
It's always fun talking interest rates, mortgage, and everything in between. If you haven't hit that subscribe button yet, be sure you do. Tap the bell for notifications so you can be the first to know about everything that's happening in our local market right here in Hartford County. There's a reason Zillow named us the #1 real estate market in the entire country, and I want you to know why. So please download my relocation guide below by clicking the link. DM me, email me, text me, call me. I'm available all the time. Cannot wait to see you on the next one. Thanks again, Jonathan Esposito of Atomic Mortgage. We'll see you on the next one, guys.
Thanks so much.